Welcome to another edition of Regulatory Ramblings Briefs. Our guest today is Vincent Turcotte, the Asia-Pacific Director for Digital Assets at Eventus, a global provider of trade, surveillance, and market solutions for multiple asset classes, such as equities, options, futures, forex, fixed income, and, of course, digital assets. He'll be discussing a report today that he wrote late last year entitled Crypto Regulation in Asia 2022, Hong Kong Update. The report was itself an update to a white paper he authored in February of last year entitled Crypto Regulation in APAC, What to Expect in 2022. It's a discussion worth having, especially since the local Securities and Futures Commission released its consultation conclusions on May 23rd with the territory's new virtual asset regulatory framework set to become effective on June 1st. Broadly speaking, Vince's thesis is this: the SFC has done a much better job when it comes to listings. It's taken a market-oriented, market-oriented bottom-up approach rather than, say, a top-down approach, as with places like Singapore or Dubai. It's listened to the market. It's also weighed all the considerations, and in doing so, it's managed to craft the appropriate type of legislation and revised AML rules like it did last year through LegCo that were sound and measured and required. He believes the local capital markets watchdog has taken a pragmatic approach, and it's interesting to see how people have responded to the 10 questions that the SFC released in its consultation conclusions, and how they measure up to Vincent's own predictions. So with that, Vincent, thank you for joining us.
Thanks for having me, Ajay. And listen, I want to preamble some of this by saying that most of the views you're going to hear today are really my personal views and not necessarily reflecting those of Eventus. We have a very deep bench of regulatory affairs guys who really does a wonderful job of helping us form our official views and so on. And we try to stay neutral in the first place. We really are not the arbiter of policy. So we sort of fit our tools and our discussions for purpose. That's really, to that extent that I sort of help with that as the eyes and ears in Asia. But we have a stronger team based in the United States and Europe that can really help with some of these issues. So there we go. That's my preamble.
Fair enough. No. Glad we got that squared away up front. So I've given a very brief skeletal outline of your thesis, but I'd like to hear from you.
Yeah,
what are the key conclusions and observations of your report?
Sure. I really appreciate that too. And honestly, I think you grabbed the essence of it. I like to sort of start out with context and go through a little bit of a history lesson, because I think it really gives a little bit more body to the discussions that are going on today, as well as, of course, the regulatory cycle that we're in.
Background's important, so go for it.
Yeah, sure. And I'm not talking about crypto history. I'm talking about other asset classes that have sort of formed up how the regulators treat these issues. Right. I don't know, back in 1993, 94, I was a futures broker here in Hong Kong, and we were all pretty excited about what was going on in China because there were new exchanges opening, things were happening. It all looked very promising for the speculative interests in China, but there was a catch. None of these venues were regulated or sanctioned in any way by the regulators in China. And the PBOC came in and really shut them all down in 93, 94. And that sort of led to a series of events that I think if you look today, we've actually seen in a speeded up cycle. So in 1999, the CFEX opened in Shanghai, and they began opening futures exchanges under the sanction of the regulators and the government. And that business, as everybody knows, has really taken off. It's burgeoning. It's one of the largest futures businesses in the world. These individual exchanges, in particular, Dalian and the INE and CFEX, have all done exceedingly well. And it wasn't until 10 years later, when Chinese investors were then allowed to start looking offshore in trading into these markets. And so 2019, there was a group of brokerages that was sanctioned by China here in Hong Kong. And they were all Chinese brokers. There were places like CITIC and COFCO and places like that, Nanhua, where Chinese individuals would begin opening up accounts to trade global markets through this conduit that of course, the regulator could keep a very close eye on. Now, let's fast forward to a few years ago. In 2013, 2014, there is no question that China was the dominant force in crypto markets, and in particular in Bitcoin. 70% of the volume was related to Chinese activity, whether it was retail or institutional. One of the exchanges in China had 30% of global Bitcoin volume, which is just astonishing when you think about it. A colleague of ours in Singapore, he actually works for Matrixport, named Marcus Thielen, has written a wonderful book about this called Crypto Titans. And it talks about, he does a very good job of summing up this historical cycle. I recommend that to anybody who wants to take a look at it and learn more. I think that you take a look at what happened when the big concern was obviously, again, the capital controls. So there was a typology of fraud that was taking place where invoices for goods and services in Hong Kong by Chinese companies was being inflated by as much as $60 billion in that particular year, that fiscal year. And what that was is obviously people padding this to move money across the border. That was linked in many times, in many ways, to digital asset activity. So they were really taking advantage of some of the capital controls and trying to find a way out. And of course, this alarmed the regulators in Beijing. And it was also, there was a real infrastructure in China for using crypto as currency. Baidu, for instance, was accepting Bitcoin. Several other merchants were accepting Bitcoin as a coin of trade, as legal tender. And again, this really got the regulators concerned, and as it would in any regulatory environment. And they basically moved forward to shut it all down. The first of the many blows that came to the market came in 2013, 2014. And then you saw obviously a big bear market in crypto after that. It almost touched $1,000 for the first time. It was about $990. And then it dropped in the following year, in 2015, it came all the way down to $222. And this is a reflection of, I mentioned this not because of the twos and fro's of the market itself, but how important the Chinese were to crypto at that point in time. Now, I think going, a piece of context is that, blockchain BSN, you've heard of that. That's China's internal blockchain that they're sponsoring the network that they're growing internally. That really just took off in 2022. So you look at the difference in the timing, when, they're moving faster than they used to. They're doing it. That's sort of corollary to the development of their own futures markets after they cracked down in that business. And you can see that they're moving in a direction where many people speculate that Chinese retail will once again be allowed to transact in cryptocurrencies. And that brings us to Hong Kong, where we have, the situation is growing up now, and all of the things that the SFC has done over the past several years, beginning with their 2018 memorandum, and then of course progressing to 2019 and 2021 and 22, when they wrote what looks to be, in my opinion, and I've been watching them write these opinions for years, but this is a very intentional and deliberate series of steps toward, a regulated crypto market. They wisely stood away from, regulating the market because it wasn't their mandate. So they created an opt-in, where firms like OSL got involved, and eventually a couple of other firms, and many firms have applied for that. But that opt-in environment was not going to be the end game, and everybody kind of knew that, or we formed that sense over a few years. And now they've come forward, wisely couching it, as we discussed in the paper, within the AML-RO regime. So that ordinance, now co-ops all of the regulatory structures, the architecture around digital assets is being pulled into the existing Hong Kong regulation. And I think that's wise. So they've created separate segments of the AML regime around it, but it is really part of the larger AML picture. They've mandated that the SFC is the arbiter; it will be the regulator. The SFC has gone on and created a separate licensing category, as well as the previously required Type 1 and Type 7. And, and that has given it sort of a feel of being adopted into the existing regulatory architecture. I think the other thing that they've done an exceptionally good job of is paying attention to international standards. It's very important to Hong Kong to be seen as a hub within the global financial services sector. And so, we've already, of course, with HKEX, we have, I think, still the third, sometimes the second largest listing environment for equity securities. They're active futures exchanges. We have a Connect system that takes us in and out of China very, very smoothly. And it's really all evolved in a much shorter period of time than that, going back to my futures example, my history lesson. So you can see that the pace is speeded up. And I think that we're heading towards a time when, and this again is, I want to stress that this is my view, not that of Eventus, but we're heading towards a time when you'll see a re-entry of Chinese retail into the market, probably through a mechanism that is very similar to the one that they use for Connect, whether it's Stock Connect, Bond Connect, Swap Connect, and so on. And that building that up will unlock a tremendous amount of value that is still in China with holders of digital assets. There is, of course, a certain amount of activity that takes place off the regulatory grid. They know that. They want to eliminate that.
Well, that's what I wanted to ask you about. I mean, is it, when you say interest and Chinese customers will return, I agree they will return, but is it going to be in an above board, legitimate sort of way, or are these new transactions going to be part of the black or the gray economy?
I think the former. I think that the intention is to create a regulated environment. And that, again, is what's so interesting to me about the current developments in Hong Kong. They have a retail, a permissible retail trading environment, which, in Asia Pacific seems pretty unique. Certainly in contrast to some of the competitive jurisdictions, allowing retail into the business is a stroke of excellence. And they've done it in a very methodical, very structured way. There's no leverage to start with. I think that'll eventually come. No derivatives to start with. They sort of punted on that in the market consultation, but they are considering it. And there will be a separate, I think, circular on how to conduct derivatives business.
Because the hedge funds have been complaining about it.
A little.
Yeah.
A little. I think that you're right. I think that they, however, have other funding mechanisms rather than sort of trading on margin. They can, work in prime brokerage environments where they will get funding vis-a-vis other assets that they hold and so on, and that'll facilitate some of their position taking. But the point is, I think that the exchange, rather the SFC, is not too excited to see retail follow that path for right now, given the risk returns of some of the recent bear market.
Well, if you look at the commentary, you look at the chatter, this is being the much of the fanfare is this opens the door for retail investors to get into crypto. How wonderful is that? And if you look at your predictions and the 10 questions in the original consultation questionnaire, how do your predictions square against the rules that the government ultimately ended up deciding upon, or the SFC and ended up crafting? I mean, how would you score yourself in that regard?
Sure. I think, maybe a B minus. I think obviously the timing changed a couple of times. There were things that we really, couldn't have predicted. They moved the timing from March, for instance, back to June. I think that I had been more optimistic about derivatives and about leverage being available to retail. The reason I thought so was because they already have the availability of leverage in offshore markets. So even if I'm a Chinese investor now, if I have futures account here in Hong Kong, I can go trade CME futures, where there is, although it's not heavily levered, I think it varies between 2 and 3 to 1 in terms of margin. And the same thing, I can go and buy ETFs that have exposure to. So, I thought that would maybe swing the pendulum locally here in that direction. And you're never wrong until it's over. I think that is coming. But I think what they want to do is really first, have everybody get moving on the same level playing field that will draw people in. And I have to emphasize that they're striking a balance between consumer protection, which is, the heart of their mandate, and also, financial technology innovation, where they want to continue to foster new products and new things happening in the market. But when in doubt, in particular with retail, they will always err to the side of consumer protection. So they're starting out slow, and I think that's wise. You can't argue with that approach when you see some of the things that have happened over the past couple of years in the digital asset space.
Certainly, and that has certainly tarnished the asset class in the minds of many. Some are undeterred; they've seen the returns, and again, the whole fear of missing out has caused them to jump on the bandwagon. And depending on when you sold, you did well for yourself. And again, it's given some people false confidence. In my view, it's interesting though that they released the about 11 days after a Hong Kong delegation, in a joint trip with the FinTech Association of Hong Kong, was in Dubai from May 7th till the 12th, visiting industry people there in FinTech, in crypto, in Dubai, Abu Dhabi, regulators and policymakers alike. And, some of the feedback I got was members of the Hong Kong delegation were wowed at how far Dubai had come along in such a relatively short period of time. When I spoke at the first Bitcoin event in Dubai at the DIFC in December 2014, there was only one place in Dubai that accepted crypto, and that was a pizza place on Sheikh Zayed Road that accepted Bitcoin. And now far more places accept it. And I guess the Hong Kong delegation was, one person said they were floored because they did not expect to see that level of sophistication and technological uptake in Dubai. That was the conclusions of their that was their impressions as their trip neared on its end on May 12th. And 11 days later, we get the conclusion. I'm not saying there's a cause and effect type relationship, but again, that and then the Chinese statement on Web3. This is a space where things are happening extremely fast and furious.
I can't agree more. And I have to say, with Dubai, I was recently speaking to our chief revenue officer who had just returned from a trip to Dubai, Abu Dhabi, and he was just wowed. And he thought, this place is just on fire. I can see how the growth and the momentum are really there, and to their credit, in particular in Dubai, and where I think that they've done just a wonderful job of recreating their economy towards a financial services and technology base, and of course moving away from energy and so on. But they were very quick to study this, and they've done a great job, top to bottom, no matter what level of the Emirates government you look at fast tracking a sensible set of regulations throughout the various Emirates. There are several different regulatory regimes there that are really worth looking at. We're involved with clients in both Abu Dhabi, ADGM, as global markets, as well as clients down who are regulated in Dubai by VARA. And they're really, really focused. They know their stuff. I would have to say, no discredit, but if you look at there's a little more smoke sometimes than fire. in terms of Dubai is flashy. They've got a lot going on, and I think they're going to do extremely well. They've drawn a number of the best of the industry players and a lot of the best talent. But there are some of the limits that they've run into with the talent pool is one thing. I mean, you kind of bump into that. And this is where Hong Kong has always been strong, where Hong Kong people have been really adaptable and much more sticky in a job, than some other markets that you deal with. But that's another conversation. I think in terms of regulation, while I don't draw, as you say, any sort of direct line between those two things, Hong Kong is very aware of its competitiveness on the global stage. And as I mentioned earlier, when they set up their regulatory structure, they've made sure. I mean, when I read the first paper that they put out, the proposal for the new legislation that was passed last year, there were 12 references to FATF on the first page. So, the global money laundering standards were very much in their mind, and they want to make sure that they fit tightly into those global parameters. The same thing is true, I think, if you look at their approach to our specific area of the world. We work, as you mentioned at the beginning of the call, in market surveillance, and I like to think of us as a post-trade analytics tool whose calling card is in surveillance. And so there's an entire section of the VTAP rules that specifically addresses this area, where other jurisdictions have not been as clear about what they want you to do to prevent any sort of market abuse, and that sort of thing. Hong Kong has been very, very clear, and it's right from I think that first reference appeared in 2019 that this is what they intended to do. And good on them. I mean, not only does it help our business, but I think what it does is make sure that global markets understand that we are watching, for market abuse, that we are watching for in Hong Kong for any kind of abusive price behavior, wash trading, things like that. And I have no doubt. I was sitting on I actually chaired a committee on market integrity for a response to the MAS last year on their market consultation. And they came right out and asked the question, should we have market surveillance as a stipulation in our rules? And the answer was yes. Like across the board, no matter who was holding the pen in the various groups, everybody sort of said, yeah, you should, and that would only bring it in line with other asset markets. There's been for a long time, I think if you ask the average person, even in the industry, what they think about the particular issue, they'll immediately start talking about, Elliptic, Coinbase, TRM, the other on-chain surveillance people who really do a wonderful job, in particular TRM, in my opinion. Again, that's just me, but of tracking, forensically tracking coins, wallets, domains, sanctions lists, and so on. But that's all happening on the blockchain, where the abuse has sort of moved over toward, or you've moved into mixers and into common exchanges, everyday crypto exchanges being used as a mixer by some of this behavior because there was no mandate that people be looking for it off chain. Hong Kong caught on to that right away and said, look, we want to make sure that we're watching off chain as much as we watch on chain. After all, it's what we do with every other asset class. Now, IOSCO, in its recent paper, I don't know if you saw it last week, came out and with the same thing. They have a specific section that addresses market surveillance and market abuse and manipulation. But it is an awareness that is relatively new in this space. And now we've been working with one of the big U.S. exchanges for many years, and they were, to our knowledge, the first people to address this problem. And they actually approached us and said, can you help us with this? I mean, they were very proactive. They've got a great compliance culture. And so they asked us to help them design the system to keep track of trades on their platform, and which we did. And that became the template for what we've done with every other exchange in that space since. So we've become a market leader in this space just because we responded to a problem that chief compliance officer at one of the big US exchanges had. It's a really interesting evolution, and now it's being codified into the rules and regulations.
Okay. Well, in the time we've got left, was there anything you wanted to emphasize to our audience that we hadn't spoken about? Like, I mean, I guess the perennial concern is always, what does this mean for compliance and legal at institutions that are going to handle virtual assets moving forward? I mean, that's always the big question. In an environment where much of what you do is compliance, what does it mean for them?
You're going to have to address the staff shortages that we're seeing in the market by really upping your game in RegTech. There are solutions like ours that provide a lot of automation that you can handle larger scales of business more easily, and that's just going to be a fact of life. I think the second thing is that, and again, another reason why I really love what Hong Kong has done. They've anticipated a lot of the difficulties that, or they've seen what has happened in other jurisdictions where there was a big rush at the beginning to get everything going, and then it was hurry up and wait for 3 years for your license. And Hong Kong has had the foresight to sort of deploy a consultant-based model where they'll be using independent consultants to work with the exchanges that are applying for licenses to help build up their business. So, if my advice would be, embrace these people, really get to, it's not cheap, but it's definitely a good investment. And there are some of the smaller ones that are focused on Hong Kong in particular that have done a very good job at helping other people find licenses are the people I would first steer you toward. I guess the third piece of advice would be, you don't have to spend huge, but you really better give yourself some runway. And meaning that if you get through the rent, the staffing, the licensing, consulting and legal fees, the technology-based fees, and so on, then you got to have a couple of years of runway, because this market is going to evolve over the space of 2 or 3 years. Before, there will eventually be derivatives, as I said earlier. There will eventually be more leverage. Hong Kong-based platforms will be seeking business from offshore, and so on. These things will take a couple of years to evolve, and so you're going to need a couple of years of runway. We've seen, I think, 3 really client classes that have come in to do this. We've seen the OGs, the guys who've been crypto exchanges forever, most of whom already have a Hong Kong office. They're well down the track. We've seen by the way, some of those guys, we're going to have difficulty with the fit and proper criteria for reasons we can discuss offline, as we all know. But then the second class are some of the big securities firms. One global securities firm and one of the big Chinese securities firms are well down the track in applying for license. And what they're doing is attempting to take this existing account base they have, both of whom they've got giant account bases, and they will be using that to leverage their presence in digital assets, virtual assets. And the third category is the one that interests me the most. And these are mostly technology companies, mostly Chinese, backed by Chinese funding or backed by Chinese family offices that have elected to set up virtual asset platforms, betting on the future of Hong Kong and the future of the retail business. And they come to this party with some really interesting ideas. They are what the OGs used to be. They are technology first and exchanges second. And I think they're going to bring some interesting innovations over time. So it's fun to watch these guys setting up, and they know what they're doing. These are calculated investments by very large companies in this space. I imagine some of them will end up either setting up a platform that they then team with another securities environment, or they will set up a platform and then go whole hog and buy a brokerage so that they can also have that account distribution that the larger brokers have. But it's going to be an interesting couple of years.
Oh, I agree. I mean, certainly it seems to me the mainlanders are more bullish, more gung-ho on crypto's future in Hong Kong than seems to be many Hong Kongers. Or maybe that's just the people I've been speaking with. And one last thing is an aside to your point about staffing shortages. You may be interested to know that the Virtual Asset Regulatory Authority in Dubai only has 12 full-time staff, 2 of whom are Hong Kong emigres. And,
one of them is a very good friend.
Yeah, well, I guess which one. And so, yeah, I mean, it would not surprise me if, and they're breaking new ground. I mean, it's terrific if you could get a gig like that and get it on the ground floor. They're breaking new ground, and that will put them in good stead for the remainder of their careers. It would not surprise me if you see within the foreseeable future Hong Kong stealing some of that talent, because again,
I would also counter that a little bit by saying I know one of the people who was deeply involved in the Singapore process, and they only had 5, that were really focusing on a full-time basis. Hong Kong has started out with 7, although I think that they're building that out. So 12 is not a bad number, but again, that's where Hong Kong got the insight that they would need to lean heavily on a consultant-based system where they could give feedback to the consultants that would give it to the clients in a form where the clients could then implement and then re-show that and perhaps show the changes that they've made back through the consultants to the regulator. So that takes a bit of the heat, from my point of view, it takes a bit of the heat off of the staffing at the SFC. And again, I think they learned that from the very difficult scenario that was in Singapore for a couple of years.
Yeah, plenty of food for thought. Vincent Turcotte, thank you so much for joining us.
And thank you for having me, Ajay. Look forward to seeing you again.
Let's do it again. And to our audience, until next time, thank you for joining us.